11:52 p.m. You're on right now. You earn £60,000 a year, solid income above the UK average. You've done what you're supposed to do, save consistently, avoided stupid debt, built a deposit. You're ready to buy. And every house that doesn't look like a construction prayer costs at least £375,000 or £450,000. The kitchen hasn't been updated since 2006. The carpets are tired. The estate agent calls it ideal for first-time buyers. Your mortgage broker says you're approved. Your parents ask when you're getting on the ladder. Your mates are posting key handover photos. So what's the problem? The problem is this. You probably can't afford that house. Not comfortably, not sustainably, not without turning the next decade into a financial squeeze. And nobody in the buying process has an incentive to tell you that. Today, we're going to calculate what your salary actually buys in income. Not what the bank will lend you, but what you can afford without becoming house poor. The UK income versus house price gap. Let's zoom out. Median UK full-time salary sits around £35,000, £37,000. Median house price in England, roughly £285,000 to £300,000. That's about 8 times median earnings in England. London and the South East, even worse. Historically, houses were closer to 3-4 times income. Now in many regions, it's 6-10 times. That gap matters more than people realise, because when prices stretch further from income, risk stretches with them. What the bank lends versus what you can afford. In the UK, lenders typically offer around 4 to 4.5 times your salary. So, at £60,000, you might borrow roughly £240,000 to £270,000. That's the approval number. But approval is not affordability. Affordability is about margin. Can you still save? Can you handle rate increases? Can you absorb a boiler failure without panic? The bank stress tests you. It doesn't design your lifestyle. £400,000, house reality. Let's run the numbers. £400,000 home. 10% deposit costs £40,000. Mortgage costs £360,000. Roughly 5.5%, which is realistic in today's market. Monthly repayment on 25 years equals roughly £2,200, £2,400. Now add council tax, £180 to £250. Insurance, £30 to £50. Maintenance, 1% £330 per month. Equipment. Utilities, £250. £350. Real monthly housing costs, close to £2,800 to £3,000. If you earn £60,000, take-home pay is roughly £3,700. £3,900 per month depending on pension contributions. Your housing is eating 70-80% of your take-home. That's not home ownership. That's financial compression. What house poor looks like in England. Let's say housing costs you £2,900 per month. You have about £900, £1,000 left. Now, subtract food, transport, car finance, or rail season ticket, pension contributions, phone, internet, subscriptions. Suddenly there's nothing left. One broken boiler, £3,000. New roof, £8,000. £50,000. Unexpected expense becomes debt. That's house poor. You own bricks. You lose breathing room. But our parents did. Your parents bought at your age. But in the 1990s and early 2000s, house prices were lower relative to income. University fees were minimal. Fewer people needed 2 full incomes to qualify. Property price growth outpaced wages dramatically afterwards. They entered the market before asset inflation accelerated. You're entering after it compounded. That's not laziness. That's timing. The hidden UK costs. Home ownership in England comes with extras people ignore. Leasehold service charges, ground rent, estate management fees on new builds, rising energy costs, increasing insurance premiums, mortgage rates resetting after 2 or 5 years. If you look into a 5-year fix of 5.5%, what happens if it's 6.5% of your mortgage? Margin payments. Renting versus buying. Uncomfortable truth. In many UK cities right now, monthly mortgage payments exceed rental equivalent properties. Buying only wins financially if you stay long enough. Prices continue rising, rates don't spike, maintenance doesn't explode. Buying isn't automatically smarter, it's situational. What your real options are, if you're stretched, you have choices. 1. Move further out, commute to towns, different regions. Geographic arbitrage works in the UK. 2. Buy smaller, lower ego, lower mortgage, higher margin, financial freedom meets square footage. 3. House hack, lodger scheme, rent a room tax-free up to £2. Buy with sibling or partner. Consider duplex converted flats. Not glamorous, very effective. 4, wait. Increase income, increase deposit, let numbers align. There is no medal for buying early and struggling. The real lesson, we're not failing. System shifted. House prices outpace wages for decades. The question isn't, can I borrow this much? It's, will this improve my life? Ownership without margin is stress. Ownership with margin is leverage. Conclusion. If you're earning 50k to 70k and stretching for a 400k property, know the real numbers. Ignore the pressure. Ignore the approval. Ignore the estate agent content. Your salary buys less house